Hi, I'm Max Keiser. This is the Keiser Report. You know, we talk a lot on the show, many years, about economy and currencies and what makes a currency. Usually what makes a currency is scarcity. For example, gold is a currency. It's money because it's scarce. That's the primary reason people use it as money. Keynesian economics or socialism is usually unworkable because the people who are organizing it think that, well, you can just print all the money you need. You need a program, print more money. There's socialism for banks on Wall Street, as was pointed out recently in one of the big presidential debates. You know, bank gets in trouble, we'll just print more money. Well, what's the ultimate scarce commodity? What is the ultimate scarce commodity? Think about it. What is the ultimate scarce commodity? Stacy.
The most scarce commodity of all is time. And that is in the headline here. IKEA becomes first retailer to let customers pay using time. IKEA is now letting customers pay for goods with their time. Yes, that's right. The more time customers spend traveling to IKEA, the more they can buy. Because beginning from this month, IKEA Dubai is running a campaign that will allow customers to spend their time as a currency, simply by showing IKEA checkout staff their Google Maps timeline, which proves how much time they spent traveling to IKEA stores.
Now, this is fascinating on a number of different levels. First of all, IKEA is recognizing that time has value. Time has value. In traditional financial markets, time also has values, and it's expressed in an interest rate. A 2-year bond, 5-year bond, 10-year bond would yield greater interest because it is good for a greater amount of time, and time has value. So it's remarkable that we live in an era in the 21st century, the era of negative interest rates, which implies that not only does time have no value, but the value of time is negative. That's what Wall Street wants you to believe. That's what central banks in Europe, that's what Denmark wants its savers who put deposits at Saxo Bank to believe that they can confiscate wealth with a negative interest rate, because according to Saxo, not only does time have no value, but it has less than zero value. Here's IKEA saying, oh, you know what? Time has value. We're going to pay you for that time in a discount. You make a purchase at our store. The point, I think, is that going forward now, the ultimate scarce commodity of time will factor heavily into all kinds of financial products in our lives. And I'm waiting for someone to invent the time futures contract. Imagine if you can trade time on a futures contract, you could travel backwards and forwards through time, which would be great, especially for Goldman Sachs. If they want to go backwards in time and steal from customers from 20 years ago, they can do so with a time futures contract.
We've kind of had that in a way, and that's what you're seeing here in the US elections, I believe. Either it's like some other nation and their diabolical memes, or it's the young people who are basically witnessing time travel, i.e. the boomers collateralized, i.e. they pulled forward the next 40, 50 years of consumption. And it was the millennials and Generation Z that they consumed their lives. So that's why there's this awkward moment of when we're at zero rates, interest rates, time no longer has value, because 40 years ago, when interest rates were up at 20%, there used to be more value to time. Now we're all the way down at 0%. And where do we go from here? We're trying to do negative. We're trying to go back in time and take back some of that future consumption that we already spent. So, yeah, this is an interesting
Right, by lowering interest rates down to zero, you encourage hyperconsumption. In hyperconsumption, consumption for 20, 30, 40 years in the future is consumed today. You end up with two things. Number one, the millennials and Gen Z inherit a lot of debt, because the only way you can bring interest rates down to zero is if you issue lots of debt and have the central bank buy that debt. Paul Krugman at the New York Times, remember, he said it's only debt that we owe ourselves. He's wrong, because it's debt we owe Generation Z, Generation Millennials, etc. So that's where the circle is squared, is that the future generations are left with this hyper-consumed world of nothing. The second corollary would be something like the coronavirus. Coronavirus is the product of hyper-consumption due to 0% interest rates, due to China's attempt to compete with America on a compressed timeline by floating their economy with trillions of dollars worth of debt and having everyone engage in hyperconsumption. Now we've got the coronavirus. That's a direct result. And so now we go back to the Middle Ages. As we've been saying for years now, a return to neo-feudalism is upon us. In some parts of China today, they are now revisiting feudal times. They've been stripped of all the modern era's technological advances, and they're digging in the ground with hoes, trying to find roots and vegetables to survive.
IKEA, of course, chops down a lot of forests around the world and turns them into, cheap bedding and cupboards and stuff like that. So in a way, maybe this is also them trying to realize that we're running out of time, and they themselves want to capitalize on that. Nevertheless, this program is only available right now in Dubai. It's dubbed Buy With Your Time. The idea behind the new promotion is that customers usually spend an inordinate amount of time traveling to IKEA outlets, usually because said outlets reside on the outskirts of towns. In view of this, IKEA has added time currency prices for every item in its Dubai stores, which are based on the average Dubai salary. As such, customers are now able to buy products using all the time they spent traveling to IKEA over the years, in addition to the usual dirhams. So I guess it's kind of like airline miles, but you're encouraging, I guess they're having problems with people wanting, do I really want to drive an hour and a half, to IKEA? But if you're being discounted the time.
Well, yeah, they're competing with Amazon, aren't they? In other words, Amazon, they don't have the problem with the superstores located 30 miles away from where you live. They have overnight delivery. So IKEA is saying, especially since Amazon is probably going to branch out into those areas like furniture that IKEA does and Amazon doesn't currently do so well, and they'll say, look, we'll compensate you for that distance. The arbitrage between IKEA and Amazon will be closed because they're going to pay you for the distance and time that you spend getting to the IKEA store. But you said something just there that's kind of interesting. Maybe IKEA recognizes that we're running out of time. And I think that is something that people are starting to realize. Remember the doomsday clock, and every 6 months or year, some organization, I don't even know what the organization is, they say, here's the doomsday clock, and we're 10 seconds closer to midnight. And up until recently, I think people thought that was a marketing gimmick, but I think now people are understanding that is, in fact, a documentary of where we are as a species. We may actually be approaching the end of the species. So why not rush out to IKEA and buy a chest or drawer for your 6-year-old before the end of time?
Another person who I think we've already discussed this, that sees that we're running out of time, is Elon Musk and his electric cars, Tesla, now his Mad Max sort of vehicle that is apparently doing very well. And of course, his plan B, perhaps he has Bitcoin, I believe he does, but his other plan B is to get to Mars, to abandon this planet and try to find more time there. But this electric car story is also in the news because, again, this is, time is one of the major ingredients in terms of financial markets and pricing, commodities and anything, equities. But it's also important for what we're going to listen to here. As electric car sales soar, the industry faces a cobalt crisis. First it was lithium, now it's cobalt. Electric vehicles need them for batteries, but supply issues will only worsen as demand rises. So there's an increasing demand for electric cars. Elon Musk has, helped popularize it. We're also running into the same old conflict that we had with the combustion engine and oil-based cars in the resource. How to get that resource. And again, that heads us towards that doomsday of more war. We have, some would argue, or some do suggest, that the situation in Bolivia is due to them having a huge part of the global lithium supply. Cobalt could be the same thing because apparently they're running out of cobalt and everybody's fighting to get supplies. It's actually hitting production on some manufacturers we'll go into soon.
Right. Well, capitalism works if the price signals are clear and they reflect true supply and demand. The problem with fossil fuels, in particular oil, for 50 years is that we haven't had an accurate price signal. Given the fact that the amount of credit and capital needed to drill and the environmental consequences of burning, the price of a gallon of oil should be, at this time, probably $90 to $100 a gallon to truly reflect the actual cost of that gallon of oil in a true free market capitalist system. Needless to say, when the price started to get to $20, $30, $40 a gallon, maybe 20 years ago, 25 years ago, then we would have already been on the fast track to developing alternatives to fossil fuels by now, and we wouldn't have waited to the very last doomsday second to say, oh my God, we didn't allow capitalism to clear these markets in an efficient way, so now we're going to become prematurely extinct, but I'm going to upload my subconscious to a computer somewhere and put it on Elon Musk's orbiting platform to get to Mars and hope there's not just another place where I can't get a date.
Going back to this story, just so you know, for electric cars, global production of electric vehicles is predicted to top 4 million globally this year in 2020, providing the coronavirus doesn't go full pandemic and destroy demand like it has in China. There's a 92% collapse in car purchases. It is expected to grow, again, providing everything continues as it has in the past. And there is, that is always an assumption for many investors. They think, oh, times have been great. Interest rates keep falling forever for the last 40 years. Stock markets keep going up for the last 40 years. It's going to continue like this for the next 40 years. So right now, if things continue on the same trajectory, they're predicting that there will be 12 million cars sold in 2025.
Right. Well, look up on the search engine there the concept of Gaia, G-A-I-A. This is the idea pretty much that holistically we live in one terrarium of inputs and outputs, and if you have an exaggeration of inputs, let's say a global cancer, that is the combustion engine, going for too long, it will kill the entire terrarium. Gaia is destroyed. But Gaia is not without their own ability to push back. So is the coronavirus Gaia pushing back against humans? Is Bitcoin Gaia pushing back against fiat money? I would posit yes, absolutely. It all, I think, goes back to the SETI project of the mid-90s, the search for an extraterrestrial intelligence, a massively parallel computing project that I was participating in the mid-90s. I believe we made contact with extraterrestrials, and I believe they reverse engineered their way back into our collective unconscious. That's who invented Bitcoin, and that is now part of the move toward extinguishing everything except what is truly sustainable. What's not sustainable is this segment. We have to take a break. And when we come back, I have no idea what's happening. Don't go away. Welcome back to the Keiser Report. I'm Max Keiser. Time now to turn to Willy Woo. He is a partner at the Adaptive Fund, crafting Hypersheet, and a specialist in on-chain analysis of Bitcoin. Willy, welcome.
Thank you, Max.
Great to see you. We're here in Vegas at the Unconfiscatable Conference. A lot of great people like yourself and others are here, and it's having a good time. Now, on-chain analysis, what is that? Why do you do it? What sort of analysis can you derive from looking at the chain?
Okay, so I like new stuff. Bitcoin, being a financial instrument, is very unique. We don't see this in Wall Street. It has a ledger. We can look onto that ledger. We see capital flows. So if you can divine that data, you can get a read into where the market's going.
You are also well known on Twitter and elsewhere for making some good prescient calls about the direction of Bitcoin. We'll get into that in a second. But let's talk about this on-chain analysis. There was a recent brouhaha over a company that's been paid $50 million per year by the U.S. government to trace coins on the blockchain. Is that separate to what you do?
That's on-chain analysis also, but it's more forensics. Is like, who are these people, where the fund's going? We tend to track within financial modeling the sheer whole market movements of capital. But actually the forensics come into it. Sometimes you want to see where coins are leaving exchanges. Are they going to personal wallets? Are miners selling? Where are they going? Are they going to OTC desks? That sort of thing is provides a predictive signal to the market. But yeah, the whole KYC kind of thing, anti-money laundering, that's another aspect of on-chain analysis. We don't deal with that.
So capital flows, and as you point out, with chain analysis, you get a unique look you don't get in other markets. And so you're drilling into capital flows, and you're seeing where this capital is coming from, where it's going. And before this, were you into financial markets?
I traded the banking collapse in 2008, 2007, 2008, but I'm a tech guy, so that's what drew me into Bitcoin, essentially. This is a new sort of field, bleeding edge, and I really like bleeding edge.
Right. Now, cash flow is very important. For example, you know, Morgan Stanley, I believe, came out with that whole acronym, the BRICS. You know, Brazil, Russia, India, China. This was the cash flow was flowing into these developing countries, and it was a new trend, and it was set in motion a whole period of investment. Do you see those types of macro trends? Do you see, can you tell us, looking at the data, that now we've got more institutional money coming in? Because people talk about it, but is it verified? Is it borne out by the data?
That stuff, it's a little bit harder with institutions because they don't actually tend to use the blockchain like retail. Retail, you hold the coins in your wallet. Institutions, they tend to hold it at a custody provider, and so some of that is shielded because we're starting to get to that phase where we do custody or ownership of those coins, and they don't actually move on chain. They're just legal agreements, sort of a layer to legal layer. So I think we'll start to lose some of the signal that we're getting from the institution. Well, we've currently got the retail side, but the institutional stuff is still sort of in the shadows, I guess, more so.
Right. Well, there's the whole shadow banking system, and they're used to trading in the shadows, so it wouldn't be surprising that they've expanded the shadow to include Bitcoin. But let's get into this idea then that studying the capital flows, you can kind of make some good guesses about which way the price is going, right? So you've been tweeting recently that the bull market is back, but this isn't trading advice, by the way, to anyone. You need to do your own research, but this is nevertheless an interesting topic. What sort of range do you see?
For the next top?
Well, so the bull market is back. So we got down to 3,500. So you saw this $20,000 blow off top in 2017, beginning 2018. Yeah, there's a massive correction, as we've had at least 4 times in Bitcoin that I remember when I lived through. And so your work suggests that is correction is over and we're back to a bull market. And so where will we be? Where is this going to go in the next 6, 9, 12 months?
Okay, so a lot of this stuff gives us directionality. You know, you kind of see where the top is, where investors are like not so happy moving coins around, new guys aren't coming in. We got very good clues at the bottom. You can see the sort of trend reversal happening between investors. Then, you know, price sort of reflects that on the markets, you know, maybe 4 weeks, 6 weeks later. But we don't really necessarily get the price at which it's going to trade at. We know the directionality. We can do other models of trying to pick the top, right? Like, for example, you could go 35 times the cumulative average of the price, and that's actually picked every single top in the 10-year history of Bitcoin. And so right now, I believe that's sitting around above $50,000. But it keeps climbing the longer it runs for. So it's time dependent. We don't know the future. We don't know how long this bull market will run. Generally, these things are 4-year cycles. If you extrapolated the current cycle with the general 4-year cycle, which is kind of like a resonance, what you're getting is these pushes because of the mining halvening. And if you imagine it's like a bathtub and you're just pushing that water and it just sloshes every 4 years, that's the kind of the cycle that we cycle in within Bitcoin. And if you make a best guess, it's above 100,000. I think one of the more common sense predictions would be around 135,000 based on the timing signature and that 35x of average cap. So I'm looking at around the 100 to 250,000 range, depending on how long this bull market runs.
Right, so you mentioned every 4 years, and then you mentioned the halvening. So the protocol of Bitcoin every 4 years, the output, the reward to mining cut in half. This is the way that the protocol works. And this year, somewhere in May, I believe, that reward goes from 12.5 to 6.25 Bitcoin. And this is, so talk a little bit about what this means to the supply. So the supply is being constrained, right?
This is significant because when we do this, the inflation rate of Bitcoin drops below the inflation rate of gold. and that becomes, gold being the gold standard of scarcity, in which we have traditionally measured money, not since the fiat world, but we've had hundreds of years before that. And now we've got this new digital scarcity, which is more perfect, which will continue to be more scarce. And yeah, I find this very significant. Like, gold is not scarce. Launch a few rockets, mine the asteroid belt. People think that's not coming, but it is coming, right? The cost of space launch is going to go 100 times cheaper, and that opens up abundant resources. So you go from this industrial age scarcity, which is not scarce, it's technologically limited, but it's not scarce.
Right.
Now
Bitcoin,
we've got maths.
Bitcoin
right?
has absolute scarcity.
Absolute mathematical game theoretic scarcity, and that's significant, and we're in a digital age.
Which gold doesn't have. Gold.
That's right.
So when you say the inflation rate of gold, this refers to the mining output per year in all the gold mines around the world, which is roughly 2% or so.
Yes, that's right.
Okay, so there's about 160,000 tons of gold above ground right now, and so that supply is increasing through mining. And the mining, the other factor on the gold side, of course, is that the cost of mining goes higher because the gold that is available is getting more costly to access. In South Africa, for example, they're getting down to the lava. They're gone down so deep. There is this concept of peak gold, which could become a factor for gold. But to your point, it's not absolute scarcity like Bitcoin is. And yeah, if Elon Musk is going to put up 66 satellites or 1,000 satellites, and the satellites are now out there, and we're going to the cost of putting that type of equipment into outer space is dropping, then sure, we could actually start mining gold where it's plentiful.
And we won't even mine gold, because someone's going to figure out how to mine gold, and the gold market will collapse because it's pricing that in.
Well, India just discovered, I believe, I'm just working off the top of my head here, I think they just found a 3,500 ton deposit in the last week.
Oh, really?
Yeah, so
Okay.
there's like a
Didn't know
huge
that,
supply shock coming out of India. But anyway, to your point, so you have mathematically certain scarcity, and the halving is happening this year, and the 4-year waves that you have observed as a long-term observer indicate that this thing's not going to start topping out to 100,000, 120,000. Let me ask you this. Will we see a transition at some point from Bitcoin, primarily from a store of value, it starts to become a medium of exchange, right? One of the issues that we have in the Bitcoin is that people like to hodl, they don't like to spend it. But at some point, if I can buy a house for 1 Bitcoin, I'm going to do it, right? So it becomes a medium of exchange.
I've already done that.
There you go.
Yeah, but that's early. Well, the volatility's too high, right? And people think we need to get to this lower volatility before we will use it, we will spend it, because you're going to spend the money that doesn't go up. So I think that, there's this, if Bitcoin wins and then that becomes a unit of account, then what we'll see is fiat currency being the volatile one. It's a while away. The correct way to look at Bitcoin now is a store of value. It needs to get bigger, much bigger. It's 1/6 of $1 trillion. Fiat is what? 90 trillion. Real estate is 220 trillion.
Gold is 7 to 8 trillion?
Yeah, exactly. It needs to get above gold before we can even start to think of payments.
Okay, that would indicate a price of almost 400,000 per Bitcoin to get to the gold level, and you think that this is certainly within the realm of possible.
Possible. I think we've got to wait at least 7 years, maybe even 10 years before we can use that as a mainstream unit of account that we will spend from.
Right. So now, when you look at these numbers, is there a point where you would look at it and say, this is a trend reversal. I'm actually going to have to revise my thinking on this, that this bull market didn't come in. If it got down to some level that would kind of change your thinking, what level might that be?
I think a lot of it has to do with the sustainability of mining. I think that if the price dropped below, I'm not up with these numbers, but I think down in the $1,000 range, that becomes we'll start to test the last strongest miner that can keep running.
Right. On that note, let me ask you this: does hash rate precede price, or price precede hash rate This is kind of a philosophical question. Nobody, I think they have multiple opinions on this. I'm in a minority opinion on this. But it's my thought is that miners will always speculate, always take a speculation that they're going to make money in the mining space. It appeals to people who want to make money. They'll always put some hash rate up there because they want to make some money. So you're always going to see hash rate and then price afterward.
Yeah, okay. Well, you know, first off, like, if we're just down to a few miners and there's not enough hash rate, then it's very cheap for, say, a nation state to attack it. And I think at a certain price point, this thing is not defensible against a very large opponent. But to answer the point of which is first, I think it's chicken or the egg. I think that the two things are in orbit with each other, and you can't say one or the other. If price goes up, hash rate goes up. Hash rate goes down, then price also goes down.
It sounds like you're more like price precedes hash rate, which is fine. I'm used to being argued down on this point. But thanks so much for being on the Keiser Report.
Thank you, Max. Pleasure to be here.
And that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank our guest, Willy Woo. If you want to catch us on Twitter, it's Keiser Report. Until next time, bye, y'all.